Good afternoon, everyone. Good to see so many people here, and thank you to the esteemed panel for joining us. We've got a great wide topic about where to invest, and having thought about a number of the questions that we could consider here, a number of angles we could take, I think want to start with an initial question as to why invest in the shipping industry at this moment in time? Why should investors invest in shipping? And so, as I go to each of the panel, if I could just ask you to maybe give a brief introduction to give your kind of background and where your viewpoint is coming from, and then perhaps start with the question of why you think, or if you think, investors should be investing in shipping at this time. If I could start with you, Richard.
The only thing that Donald Trump and I have in common is neither of us could get into Wharton today. And I'm a graduate of the University of Pennsylvania, and I have a Wharton MBA. I spent the first 7 years of my career in the shipping industry, and I decided to go back to school at that point. And afterwards, I got into the investment business. I spent 17 years in lower middle market private equity, but I also worked for the private investment arm of two families, and I was responsible for one of the family's endowments, which I invested in shipping, and I've been following it ever since. Today I'm a public market investor only. I'm an RIA. I manage money for a few ultra-high net worth individuals and my family. And I'm here today and I invest in shipping because I think the risk reward is really good. And I've made a lot of money in the last 3 years, and I think the opportunities are even better today.
All right. That's a hard one to follow. Jim Cirenza. I've been in the securities and equity capital markets business for the last 40-ish years. Started at Goldman Sachs. A decade ago, I was at Carnegie, and for the last, more than a decade ago, in the last 13 years, I've been at D&B. Built the equity and fixed income sales force internationally, and I spend the majority of my time, in fact, all my time now in equity capital markets. But over time, I spend an incredible amount of time putting companies in front of investors. As an example, in the US alone last year, we did over 100 company roadshows with US institutions. That's 100 days of roadshows, of more than 70 were physical. So we do our best, and I do my best to get a handle on what investors are thinking and what they like, what they don't like. Anyway, shipping is hard to talk about as a sector because it's a subsector of a subsector. You know, shipping belongs to transportation. Transportation belongs to industrials. There's only 11 sectors in the S&P 500. But nonetheless, in a period of time where alpha generation's been very difficult, you know, Magnificent Seven plus Pfizer have been amazing performers since 2021 or 2022. But everything else has given you pretty close to zero or a single-digit return. Shipping has been a tremendous alpha-generating space, and I don't think that the story is over.
John Wessel. I'm Managing Director of Oldendorff Overseas Investments, which is an asset manager focused on real assets. The main asset is basically Reederei Nord, a Hamburg-based tramp owner investing in bulkers, tankers, containers. But during the last shipping crisis, which Mr. Stopford alluded to, so 50 years ago, we started to diversify into other sectors, real assets, so across the board, private markets, and most recently also liquid markets. With regards to the question, it's very hard to differentiate, but as we are here pure shipping community, I'm just looking at tonnage for now, and I would say no, it's not a good time to invest in shipping because it's too expensive. and the returns will not, you will not be able to make the returns who justify the risk.
Thanks very much. Andrew Hampson. I'm CEO of the Tufton Group. We run private and public investment funds into hard assets. We run a listed vehicle in the specialist funds segment of the London Exchange. This goes by the imaginative ticker of SHIP.L. Cost me £3.45 on my Barclay card to actually buy the ticker, which shows you how popular shipping is on the London Exchange. We also run a pure-play stainless steel tanker company on the Oslo Exchange, STST, of which I'm also CEO. I've only been doing this for about 40 years, so I'm still learning, and a lot of ways to go yet. The question was, what was the question?
What was the question? It was, is this the right time to be investing in shipping?
Right, okay, well, we were going to take this on. I'm sorry if I steal your thunder here, Will, because I know what you'll say. I think one of as managing institutional funds in shipping and getting institutional investors into shipping is a very difficult thing to do. All of you in the room, I suspect, or nearly all of you in the room, are already bought into investing in shipping. That's why you're here. You're understanding it and learning about it. When we go out to institutional investors, we've got to convince institutional investors as to why shipping. Why is shipping different from any other of the asset classes or any other industries that they might actually invest into? And that's a very hard sell for an industry which is so diversified, particularly from an ownership point of view, lack of public capital markets performance, shall I say, to put it politely. And so actually getting people to invest in shipping in the first place is one of the hardest tasks we have. Should you be investing in shipping? Clearly, I believe firmly so. I think the risk returns are there. You're really investing in world trade and an understanding of world trade. It's not going to stop, irrespective of whatever happens in the world, and indeed, it's most likely going to go further routes as various geopolitical events crop up, and that in itself creates further demand, and there is limited supply and there is limited capacity to actually build new supply, even though the order books are very full. And I'm sure Martin, if you go back to Martin's slides, I was wanting to know if he had some of them actually for today to carry those same projections through, but I think that would be interesting to see. Very limited supply, strong demand at the moment, growing demand because of geopolitical events. I think it's a great time to be investing into the fixed asset side of shipping.
Thank you. Whereas I'm Will Homan-Russell, I'm the Chief Investment Officer of the Albemarle Shipping Fund, which is a long-short hedge fund investing mainly in listed equities, but also in FFAs and commodity derivatives. It's about $200 million of AUM today. We set it up to January 2019 and have enjoyed some good performance over those 5.5 years. I started my life working with Andy at Tufton in 2003, so I've learned all of my wise ways from him. So yeah, I've been doing this for 20 years now, analysing and investing in the space. I, perhaps from my long-term fundamental history of Andy's way of looking at things, agree that fundamentally, given this lack of shipyard capacity, or at least tightness there, it remains a good period to be fundamentally long shipping. But our fund is nonetheless long and short, so as the cycle peaks, we'll move to a position of neutrality and outright short. So hopefully be able to continue to generate alpha throughout the shipping space. And shipping is very diversified. There's a lot of mispricing between various companies and subsectors, so it continues to produce a lot of opportunities to us to create that alpha.
Thank you. Just picking up on something you said, Andy, and kind of, I guess, linked to something John said, you have the tough task of getting investors to invest in shipping. Have you found that tougher in recent times, or easier, or about the same, I guess?
Well, I think it varies. I think going back a while, going back a couple of decades, I think there was a big education process going on. And I think generally a lot of institutional investors who hadn't looked at shipping in the past actually found there was an education needed. I think a lot of that has been done, although of course institutions and people change. So I think that was one of the first hurdles. I think one of the interesting things at the moment is that, and as I just said earlier, talking about geopolitical events and stuff, which of course we've got a phenomenal amount of going on at the moment. Things like that scare people. Now, I mean, those of us in the know and in shipping, might see some of those geopolitical events as opportunities, be it Russian-Ukraine crisis, be it the situation in the Red Sea, container ships having to go further round, etc. I see that as a massive opportunity. To most people reading in the headlines that Suez is closed or that the Ever Stuck has remained in the Suez Canal for too long, those are big warning signs that and the first reaction is, oh, it's risky, it's phenomenally risky. Let's not go into it. Pirates off the Somalian coast, etc. as well. All of those types of headlines really don't work towards. So I think in terms of that increase in geopolitical risk, I think that's a real negative. Not wishing to comment on UK politics too much, but from a certain time when a very short-lived UK Prime Minister was actually in power, I think that really messed things up, from then on from an economic point of view. And I think we saw a lot of institutions who were previously quite interested in riskier space. I'm not necessarily saying shipping, but in riskier types investments. A lot of the investment world went into risk off at that stage. And I think since then, we've seen a lot of pension funds and other institutional funds looking to seek investments which they consider to be far more liquid than the shipping industry is actually known for. So I think it's harder today than it was, say, 10 years ago.
Yeah, I think you can make a flip argument, and I think a lot depends on your time horizon. And I look at long-term, since I'm in equities and debt, from 6 months to 2 years. If you actually own the assets, it's a very different story. But as the UK commits energy suicide, it's really great for Texas. And we have cheap natural gas. It's associated from drilling in the Permian. And the more wind you use in the UK, for example, the more natural gas that we'll use. I heard talk of biofuels for dry bulk this morning. It's wonderful in Texas because you generate, you need a lot of fertilizer to grow corn, which is 40% for transportation fuels. And Texas has cheap natural gas. We're going to have cheap ammonia, cheap petrochemicals. And to the extent that Europe doesn't really want to manufacture anything competitively anymore, it's going to benefit shipping, and it's going to benefit Texas.
Great. And unfortunately, I agree with you. And being German, it is particularly embarrassing to sit here. And yes, you're right. There is certain ways of commercial suicide and energy suicide. But leaving that aside and coming back to your point, I think there are a lot of investors who missed out on this shipping super cycle, and some people try to jump now onto shipping, and the capital inflow we have seen is unrivaled basically so far. But that led to my answer, the very short answer, that right now there's too much capital, right now there's too much of an order book. and things need to calm down before it makes sense to look at concrete tonnage again. Tonnage, not shipping transport equity, tonnage. And ultimately, I also agree with you, and in the long run, we are far more positive because the uncertainty certainly increases, and there are many, the whole new second globalization wave, as the US is referring to with trade defense against China, will create inefficiencies and will create ultimately more ton miles. So yes, in the long run, great. Today, so-so.
But are you just looking at asset pricing, or are you looking at yields? I mean, I think one has to look at, I mean, it's very easy just to look at asset pricing. I think this is, I mean, I remember, as I'm sure my friend in the audience, Paula, will remember also when we first launched SHIP, that we didn't have a single graph in the prospectus that showed historical values or historical freight rates, because what we believe in is actually the yield on the assets, the return on the assets. And it's very easy just to say, oh, prices are too high today, but one has to look at it in conjunction with what the longer term potential yield is on those assets, particularly as we're going through periods of inflation, good for shipping, by the way. You know, that as we're doing that, you have to look at the yields more than just pure pricing and just say it's too expensive today.
You mean there is a new normal?
But in reality, over the longer term, the second-hand asset prices will be set by the cost of the replacement asset built at the shipyard, driven by capacity, replacement cost, utilization at those yards, the increasing complexity, the growing CGT versus deadweight coming out of those yards. So that sets the kind of the fair price of midterm versus the utilization to give a freight rate. When looking at that, asset prices aren't particularly high.
You know, I think part of the problem is every time a hearse goes by, you lose another value investor. And, you know, there's no one who's running a Wall Street firm who got there by doing deep value. And you can't expect anymore, just because something is ludicrously cheap, to automatically tell people and have it increase in value. The companies have to take self-action by buying back stock, paying large cash distributions. And, you know, in my world, I think investors over time have gotten stupider. And, you know, the fact you can trade from your telephone has really made the idiot the marginal dollar in pricing stocks. And I mean, it's not fair, but that's what reality is. On the other hand, you know, to Andrew, yeah, I mean, you want to, generally speaking, owning assets that have demand where the replacement cost is significantly higher and you're generating positive free cash flow yields in an environment where 40% of all high-yield bonds are trading at, you know, investment-grade rates, it's attractive. You know, that's the yin and the yang. The fact that more people don't do it means the returns are better for the people who do.
Or they don't have the right access to be able to do it.
Yeah.
I guess that leads on to another question of
Jim had something to say.
I just wanted to add to the idiot comment, which I found quite amusing. but possibly the biggest idiot in the industry now is the passive ETF, which from an institutional point of view on the equity side is 60% of the money flows. They all buy the same stocks in the end of the day. Their best day might have been July 9th and July 10th, because that was the day that the NASDAQ made its all-time high, the Nikkei 225 made its all-time high, and the yen troughed at 162. And you look at the correlations of all those since then, boy, they look awfully correlated, don't they? So if you've got a biggest problem with your biggest long, which is US tech, and you got a biggest problem with your crowded short with this Japanese yen, and you look at all the passive money which has enabled all these stocks to trade at incredible valuations, the number of people making active decisions on the equity side is shockingly low. The number of people making active decisions on the fixed income side is shockingly high. And so you can guess which market I trust more in terms of which way is a security going to go next.
I want to add something really important. I've made a lot of money listening to Jim in the past, so you don't have to listen to me, but you should listen to him.
Thank you.
And that was actually where I was going to take the next question. What type of investors are you seeing? What's the nature of the investors that you are seeing, and what are their drivers' goals at the moment?
Repeat that again?
What type of investors are you seeing at the moment? What's the nature of the investors that you're seeing, and what are their main drivers' goals at the moment?
I would say over the last 3 years up until the end of the second quarter, we've seen the broadest interest in shipping that I've ever seen. So you can take that back to the 1990s, and before the 1990s, shipping didn't exist. There were 2 stocks listed in the US in the 1980s. The breadth of ownership in the US, quite high. The breadth of ownership in UK and Europe, not as high. But the beauty of what happened in shipping coming out of the pandemic, with the container industry, with all the industries, you had alpha without chasing crazy valuations. You didn't have to pay 20 times EV to EBITDA, to own something that grew and performed well. You didn't have to pay 30 times forward earnings for something. And so shipping was one of those alpha-generating segments that didn't require you to make crazy initial valuation judgments. And this notion that every time a hearse goes by, we lose another value investor, I think we're going to see Hearst going by in the near future, which have some growth investors in them.
I look forward to that.
Will, how about you? Are you seeing a different type of investor?
Well, sorry, he pointed to me.
Who's pointing the story?
Yeah, he did so well. I guess in reality, what I'm investing is a pretty small niche. The total global listed equity market in shipping is less than $500 billion. So because of that, you can't run a very big fund within it, because you need to be moving around long, short these various equities. We want to be fairly concentrated in our ideas. Because of that, the people we are looking at to be an investor, these are family offices, these are high net worth individuals, they're smaller institutions. You can't get these huge endowment pension funds coming and putting hundreds of $1 million into what I'm doing. So there is certainly more interest from these investors that we're talking to, but the type of them aren't really changing. Maybe the geography is changing slightly, and certainly the US family office has become a lot more interested over the last 18, 24 months, whereas maybe Europe were a little earlier to the table in 2019, 2020.
I think from Tufton's point of view, we've got a pretty broad mix. As Will says, a lot of family office money. We've got committed capital at the moment of about $1.5 billion. A lot of it is from UK and European pension funds, other institutional asset manager investments. We've tapped into the UK regional government pension fund schemes, and also on the retail side. Ship.L listed in London. You can put it in your ISA if you want. Not that I'm recommending anybody, of course, to buy anything without the proper risk warnings. But that can go retail as well. Stainless in Oslo is mostly institutional, but again, a lot of retail, a lot of smaller scale there, but also family offices. So I think there's a pretty broad mix that we're seeing.
Great. John, Richard, anything to add on that one?
Well, actually, if you look into Norway, Oslo, funny enough, I think there are quite a lot of German owners actually investing, German ship owners investing in the liquid equity. But apart from that, no, I think everything has been said.
Well, in a year of elections, and you've talked about some of the kind of major geopolitical issues going on at the moment, what impact, if any, do you think they'll have on the level of investment, the type of investment?
I think it's a mug's game. And the reason why I say it's a mug's game is that I was here in 2019. We weren't worried about COVID. We weren't worried about Russia invading the Ukraine. We weren't worried about the Middle East. Whatever I was worried about in 2019, it was the wrong thing. And I think to try to second guess what geopolitically is going to happen is really hard. I mean, let's say there's peace in the Ukraine. I hope for that. You're going to have a dry bulk boom because you'll have the grain exports from the Ukraine, and there will be incredible steel demand to rebuild the Ukraine. Maybe that's a 40% chance. So I think the way I think about it in public markets is there a majority of error? There is a publicly listed company, Starbulk. It's trading below 65% NAV. They have a fortress balance sheet. They have low costs, very attractive. I'm not saying it's going to do well. I'm just saying the risk reward is good. Generally speaking, if you can buy companies at a significant discount to NAV and they've got value, you're going to be fine. But Jim, you're better at calling these things than I am.
So first, the election. The obvious stuff is if Trump wins, it's bad for windmills and wind installation vessels, but it's good for molecules out of the U.S. and drill, baby drill, and more licensing. And so most of the shipping-related segments would do well. And arguably, the container segment would face greater sanctions with a Trump than they would with a Harris. So that's the obvious stuff. But as far as, my view on the segments, a year ago, my favorite segment, and I like to use this period of time because September, October tends to be really rough markets, and I think this year they're going to be really, really rough markets. So you don't have to turn around and buy something today. You can work your way into a position over a couple of months. But a year ago, I thought that everyone hated dry bulk, so I liked dry bulk, and to me, the risk-reward to get dry bulk going wasn't that high, and here we are with day rates on Capes in the high 20s. And so that's worked out all right. The year before that, the most hated sector based on priced NAV was the LPG sector. And so some of those stocks went from 60 cents on the dollar of priced NAV to as much as 115, 120% priced NAV. And there's been some capital raise and there's been some M&A, and so that's worked out pretty well. So this year I need more than 12 months on this bet, but I really like the LNG chain, and everyone's scared to death about the order book next year and soft 25, and so maybe I need 2 years for this to play out. But I like every part of the LNG chain. You got to freeze it, you got to ship it, you got to warm it up on the other side. And so warm it up on the other side, accelerated energy, EE in the US, not expensive. Shipping it, we had Richard up here earlier with Cool Company. His stock is trading at 55 cents on the dollar. And these companies, they've booked out their fleets. They're essentially yield codes for the next few years. The freezing will come. But I think the real opportunity is going to be on the side of liquefaction. And I think if you take a 2-year view on Golar, the EBITDA, once they get asset number 2 and asset number 3 in play, the EBITDA on that company, I think, is going to be sensational. And you can decide what multiple you put on that.
Again, only looking at the assets, not at the listed companies above, I see a significant impact on container vessels. Whatever the election is going to turn out, because either the already in place tariffs are going to be prolonged, as Biden did, or they're going to be even worse when Trump comes into power. However, people have already reacted, and that's why we saw such large volumes of containers. I think the panel this morning alluded quite well to this fact, but there has been, I think, twice as much container throughput in LA in 23 and 24 than in 22. I think we're going to see this going down because everyone just wanted to get prepared for the election. So I think I see a very rough 25 for container vessels, whatever the election is going to turn out. Yeah, you pointed to the obvious other questions. I think anything carbon related, energy related is still having a good lookout. I would probably buy ADNOC shares. But
I think I'd maybe add the car carrier trade to one that may be impacted with trade wars if there's a change in the US. Outside of that, again, I agree with John. We're pretty keen on the energy space and the gas, and also in the chemicals. However, what we tend to look at looking longer term is to look at diversified fleets, and that's always been one of our mantras for the London listed vehicle, is to try and look at diversification. I think the other thing that we haven't mentioned here, and we've talked about equities and we've talked about assets. There's a lot of other opportunities. I know looking around the room, there's a lot of people here in the debt space, for instance, and I think there are a lot of opportunities, particularly with interest rates coming down in the debt space. I think also, I'm talking about within the maritime world, and I think also from the venture capital side, and we've recently launched a small venture capital fund at Tufton, looking at the IT side of things and looking at the green transition. And I think the venture side in shipping now actually starts to look attractive as well. So I think we shouldn't just be narrow enough just to think that the only thing out there is actual equities or ships. There are other ways. There are other ways to invest into the maritime industry.
Such as via a long-short equity fund.
Absolutely.
And I mean, I agree with many of the things that have been said. I mean, certainly the more favourable subsectors fundamentally are those larger. I mean, we've got tank, dry bulk. You mentioned LNG further out in time does look attractive, but we've got to get there first. Seasonal recovery in tankers should be happening soon. On larger dry bulk, we've been investing more in deferred FFAs over the last year, which has been working very nicely, and there are steep discounts to the implied replacement cost of those assets. So there's a number of different ways of looking at the space and finding value, whilst overall fundamentally believing that we should continue to see a general recovery in the space.
Great. And we've got just about 5 minutes left, so I guess, Jim, you may have answered this already in more detail, but what is the hot area that you're seeing that you recommend investors start looking at now?
Yeah, it's a tough question. What we are basically doing has. We are withdrawing as much money as possible from shipping and putting it into liquid assets. But that is not the point here. Cash, yes. I agree with you. There are ventures which appear to look interesting, and there is, of course, the whole green tech question. And I think there are many things have been discussed. We don't need to repeat this here. But the only thing I would point out is that it doesn't always have to be a new AI question. I think one thing which is overlooked is basically workforce. There are simply not enough. capable technicians, for example. So V-ships obviously just didn't make this whole consolidation story work. So if you just now set up your little services shop in whatever key segment you might find the suitable people for, I think it's a good idea. We've certainly done so, by the way.
I don't really want to get into sector picking. I think just talking more generally, and just one comment then if we're closing on this round. If I might publicly disagree with the legend, which is Mr. Stopford, in his last speech, when he actually said that we won't know when the next peak is until it happens. I think that's actually incorrect, Martin. We won't know until after it's happened. And I think that that's actually very important, because one of the most important things that we've found in investing in shipping is actually divesting from shipping and working out the timing to actually get out at the right time in whatever cycle it actually is, that you don't know it's the peak until after it. So you've got to work out a way to know when to actually get out before that peak happens. And that would be my advice.
Thank you. Will, Richard, anything further any other areas that you see as the new hot areas? I know green tech's been mentioned.
Well, I do have some green plays, but remember, in the last 3 to 4 years, the clean energy index is down 80%, and the conventional energy index is up 300%. So, I think the way I look at things, and I joke that I have opinions, and if you don't like my opinions, I have other opinions. Look for the area that everybody hates, where the CEOs don't come anymore, and they just send the CFOs, and they're suicidal. That's a market bottom, and you should buy. And if you see the areas that every analyst loves, you're probably in the last 20% of price appreciation. So, it depends on what opportunities are on offer. That being said, and I reserve the right to change my mind tomorrow, I really like Navigator, LPG, I like dry bulk, I like products that have to go long distances. I like LNG because everybody hates LNG. And, we'll see what opportunities present themselves.
Well, on that note, I think we're just about to run out of time, so I thank all the panel for taking the time and sharing their views today, and hope you enjoy the rest of the conference.